Hey guys, welcome to the Personal Finance, and today we are going to discuss something really interesting, and that is about Monte Carlo. But as usual, we begin with a quick disclaimer. I'm not a financial or an investment advisor, and I provide Excel models, and those are a must use in my view for financial planning, right? These kind of models is not being shared by anyone in India, and I mean, of course, freely, right? So, and I'm providing all these things for free to my subscribers. So please do subscribe. Subscription helps us to let the fire spread. So today we're going to discuss, as I mentioned, about Monte Carlo. But before that, let's quickly jump into what this calculator was all about for somebody who is really new to this channel. Okay. So this calculator is a retirement planning calculator which uses, right, which ensures that there is a consideration of tax, there is a consideration of inflation, there is a consideration of many other things in terms of rebalancing, right? We rebalance our portfolios as we enter into retirement. Now, this entire thing is one simulation which is based on one corpus value and one annual expense. Of course, some of you might have seen my goal planning sheet, and what happens is this particular calculator gets into goal planning. Maybe in a couple of weeks, I'm going to shoot that video as well with Monte Carlo simulations. Okay. So now the way this calculator works is we generally assign, right? We generally assign some sort of corpus value here, right? So we assign a corpus value of 5 crores as an example, and then we say annual expense is about 10 lakh rupees, and we have a couple of models in here, right? So if you see here, we have a fixed model wherein all of the Nifty returns is considered as 10% for all throughout the years, right? All of the models are considered 10%, right? And then this 10% is, of course, that's not how the market works. We all know that very well, right? So, but then still, we just simulate this with a 10% Nifty model and try to figure out. If you see, we consider a fixed asset tax, we consider long-term capital gain tax, right? So, for example, if you need a 10 lakh rupees annual expense, you need to withdraw, right? You need to withdraw close to about 1,85,000 rupees for a 60-40 split in terms of equity and debt, right? So I hope I'm making myself very clear, right? If you have a 10 lakh rupees withdrawal, you need to pay 85,000 rupees extra for a tax, right? Okay. Now, so and this is all rebalancing. You can change all the rebalancings. Yes, whatever you want, you can change your rebalancing as and when you would want to rebalance. Okay. Right. So this is the fixed model that I was talking about, right? Now we have multiple models here. So if we run a fixed model as an example, I just say click to calculate. If you run a fixed model, a 5 crore rupees corpus is going to last 96 years with a 60-40 equity and debt ratio. Okay. We are running a fixed model right now, which considers 10% Nifty returns every year, right? Fine. So now, when you say a 60-40 split, that means 3 crore rupees is kept for equity and debt 2 crore rupees is kept, and every 5 or 6 years there is a rebalancing happening. Okay, I hope that's clear. Now this Excel considers also multiple models, so I just make here model and I say my first model which I have crafted in terms of modeling. And how did I craft this? The model is crafted looking at US equity data and India data of equity, and over the past 15-20 years, whichever is available in India. And that's how the entire model is crafted. And based on that, I have made some sort of assumptions in terms of Nifty. For example, how did I make it? Every 7 years, the Indian equity market is going to go down by 1 or 2 years. Every 10 years, there's an economic shocker and it goes down minus 5, minus 6% and all those things. Let's see. If I run just one model of the carefully crafted Nifty model, let us see this 5 crore rupees and 10 lakh rupees annual expense lasts for how many years? So I'm just computing it. I have clicked to calculate. And if you see here, right? If you see here, the 5 crore rupees corpus lasts for 82 years. Okay. For a person 44 years of age. Okay, for a person who is 44 years of age, this 5 crore rupees corpus lasts till 82 years. Let me repeat. This is a one-time model. It's not, there's no regression happening here. It's a one-time model that's happening, right? And a 5 crore corpus is lasting till 82 years if I consider a 10 lakh rupees annual expense increasing at this percentage in terms of inflation. If you see here, right, all inflation percentages, all this inflation is modeled based on this Nifty data and a debt data. Okay, I have considered a debt returns, I have considered Nifty returns. Okay, fine. So now the customized model I was talking about, say if you see here carefully, right, I have considered this year, remaining year 8% returns, next year minus 15%, 9.5%, and so on and so forth. Okay, now this is one time model I have considered. So just to repeat, a fixed model that is 10% Nifty returns gives, it lasts till how many years? 96 years. Okay, a fixed model lasts till 96 years. Okay, and a one time model, so if I go to model, a one time model will last till 82 years. So 94 years versus 82 years, right? Obviously. Now let us see if this customized model is run multiple times, meaning there is a 8, 15, 9.5, 14.5. So this customized model is running in a circular way. Okay, the customized model runs a circular way. It calculates 73 models. Okay, it calculates 73 models in 60/40. So the ones who have seen this calculator before, kindly please note that this calculator has changed. It has become even more accurate, right? The fixed asset tax is modeled, everything is modeled here, right? For example, long-term capital gain tax is modeled better, and all those things is happening. So please request for the calculator. My subscribers know that the calculators are free. They can have the calculator when they want. Okay, now I'm running a multiple, so fixed 96 years, one-time model 82 years. Now let us see how long will a multiple customized model work for. Okay, if you see here, this count is changing slowly to 1, 2, 3, 4, and this is for 73 models. It's going to run now as we speak. Okay, so let's fast forward this. It's going to take some time. For 73 years we are through. Yeah, we are through, and right now the model mentions that it is for how many years. Now this is quite interesting. If you see here, the model says that till 77 years the corpus is going to last with a 97.3 confidence percentage. Okay, till 77 years it says 97.3 is the confidence percentage that the amount is going to last. For what? For a corpus of 5 crore rupees, 10 lakhs annual expense adjusted inflation. Okay, it says the corpus is going to last 80 years, 75.7% is accuracy. Okay, and it says that the corpus is going to last 85 years with only 18.9% accuracy. This is all the confidence levels that we are mentioning in this. Okay, I hope you know how to read. Let me just clear once again. It says that, as an example, the corpus of 5 crores is going to last till 80 years. At what accuracy levels? It says 75.7%. For 75.7% cases out of 73 iterations it has run, the corpus will last till 80 years. Okay, I hope you know how to read this. This is all confidence levels. So almost for 50% confidence level, the corpus will last till only 82 years. Okay, I hope this is clear. Now let's jump to something really interesting for what we are in this video, right? That is Monte Carlo simulations. Okay, now we have seen that the corpus is going to last, when you say a fixed model, it lasts for 96 years. When you say just one time model simulation, it says till 82 or 83 years. And when you say a multiple regression model, the customized model that I have built, it says the corpus will last till 80 years, right, with a 75.7% confidence level. Okay, now let us see if we run Monte Carlo, and there are a couple of parameters that we have to run for Monte Carlo. One is Monte Carlo, how many times you're going to run Monte Carlo. how many cycles you're going to run for Monte Carlo. I have said here, we're going to run 500 cycles of Monte Carlo. Then we say, what is the mean and standard deviation of Monte Carlo? I have taken a mean of 9% and I have taken a standard deviation of 8%. What the hell that means? It means very simply this thing. If the mean is 9% and standard deviation is 8% and you are 95% confident, right? If the mean is 9% and standard deviation is 8% and you are 95% confident that this is how it's going to behave, it means that the Nifty will reach a highest level of 24.7% and lowest of minus 6.7%. Okay, so at this mean and this standard deviation, it means the highest of Nifty will be 24.7 and lowest of Nifty will be minus 6.7%. Okay, it's all randomly happening. Okay, it's all happening randomly. Okay, now I'm going to run this Monte Carlo with these functions that I have told, 500 cycles of Monte Carlo, 9% of mean and 8% of standard deviation with rebalancing every 4 or 5 years with all the consideration of taxes, right, for a 44-year-old person and 5 crores of corpus, 10 lakhs of expense annually. Let us see, and a 60-40 of course equity debt ratio. Let us see how long is this corpus going to last. Okay, so now again I have run this calculator and let us see if this begins. So if you see here count, this count is slowly increasing, right? It will increase slowly to 1, 2, yeah, percentages. Again, if you are new to this channel, you might see what is this comment section. I have turned off the comment section here. If I turn on the comment section, all these places you are going to get a comment about whether rebalancing happened or not, right? What is the kind of mix that we are going to continue? What's the strategy that we have used in terms of this retirement, all those comments. But I have turned off the comments. Primary reason to turn off the comments is very simple, that we do not want this to be extremely slowed down. So I have just turned off the comments so that we can get a little bit faster in terms of our simulations. Okay, so we'll fast forward this. I'm going to pause the video and I'll come back to you once this count reaches almost 490 or something like that. Until then, let's wait and I'll come back to you shortly. Okay, so we are almost getting done and we are on the last few counts and we are almost another 2 more counts and we are done. Yes, we are done, and it shows very interesting results. It says the corpus is going to last. The corpus is going to last for till 79 years with a confidence of 75%, right? So it says for 75% of the times, that means out of 500, 75% of times it has said that the corpus of 5 crores 10 lakh annual expense is going to last till 75 years. I think it's good that we have a 75% of confidence measure. I think that is good enough for a retirement planning, because I have what I have considered right now in this entire retirement planning is that if you see here, I have not considered that the retirement expense is going to reduce till you are post about 70-75 years. I have not considered that. All I have considered is that retirement expense is going to stay till of 10 lakh rupees annually, inflation adjusted, till the point where planning retirement, right, whatever 80-85 years it comes. So again, in my view, it's good that if we say, even if we consider 75% of confidence measure, it's good enough. So Monte Carlo simulations, that is random values of Nifty, the way I mentioned, right, with a 95% of confidence level, it says that with 75% accuracy that the corpus will last till 79 years. Okay, it's saying the corpus is lasting till 79 years. Okay, that's, my friends, Monte Carlo simulation for you with a good confidence level that we were talking about, right? That is exactly what we needed in terms of a very, very succinct way of presenting things. That okay, fine, till what percentage confidence that you have that this corpus is going to last, and we can clearly now say that the corpus will last till 79 years with a 75% of cases saying that, you can say confidence level saying that it's going to last, right? Some of the viewers of this community have commented saying that we do not need such a big calculator. Anybody can say that this 5 crores corpus with 10 lakh rupees can last for a very, very long year duration if we just consider a 4% fixed deposit and a 6% inflation. All right, that kind of analysis is done here. The comment is right. Analysis is here. If I consider a real rate of return of 0% with a 10 lakh rupees and a 6% inflation or typical inflation, right? The corpus will last till 93 years for a person who is aged 44, right? The problem with this is the inflation can be tackled only with equity, right? Inflation you can tackle only with equity. Although we have said real rate of return is 0%, right? Which is of course real rate of return. We don't have to consider inflation or of equity returns, anything, right? But then all the calculation only works only for one particular thing, that what is the confidence measure if I am going to invest in equity, right? That end of the day, that's the only confidence that you need to have. So 4%, 6%, 0% of real returns, or -5 or -2%. If you see, if you have a -2% real rate of return, for a 10 lakh rupees going to last 77 years. Fixed deposits, putting everything in bank, it may not be a great idea. With all those things having said that, equity is the only tool right now in Indian markets that can adjust for inflation. Okay, so with all these things having said that, I hope the Monte Carlo analysis was kind of clear to you. So again, just a quick recap for everyone. This is a simulation doing for a 5 crores corpus, 10 lakh rupees annual expense, right? Multiple Monte Carlo. So, I mean, Monte Carlo is multiple, but then yeah, a randomized simulation with a 9% mean and 8% standard deviation, and with a -3 and all those things that I mentioned earlier, right? So yeah, that's about the Monte Carlo. Just to repeat, it says extremely simple that this corpus with a 75% confidence levels last till 79 years, right? That's what it says. With what assumptions? It says with an assumption of Nifty moving till from 24.7 to -6.7, 95% probability, of course, confidence level. But it says that, okay, fine, -6.7 could become, you can see some numbers like -8 because remaining 5% almost says the Nifty is going to move, right? So yeah, that's about this calculator. All my subscribers know one thing: you get this Excel for free. You can try it for yourself. Just email me and I'm going to share this Excel to you immediately, right? And you can put this Monte Carlo simulation 1000 runs also as if you want, right? And you can check your confidence levels or measure, right? This is the only calculator right now available on internet which gives you taxes consideration, which gives you rebalancing, right? Every 4 or 5 years. Of course, that's not how it works. We rebalance based on the present, the past year's data, Nifty or debt, but we are rebalancing with a 60-40 ratio. This is the only calculator which models the inflation as well, right? Every inflation it models. So yes, please request for this calculator and you will get the calculator free. I don't charge anything for the calculator, right? And one last request, please subscribe. We need to grow this FIRE community. Share this to your loved ones whom you wish happy financial planning to them, right? Share this to people whom you want in FIRE journey and be happy. This is again 100% FIRE. I am going to integrate this with the goal planning sheet, and you will find really something really interesting in coming days, right? So thank you so much and happy financial planning.